Do your charts look like this? If this looks familiar at all, then this is really a video for you. Indicator piling is something that technicians or technical analysts deal with quite a bit, particularly new technical analysts. The theory is it goes kind of like this. Let's say, for example, that you like to use stochastics as a technical indicator, and you know that for the type of trade you're looking for, the stochastics indicator gives you a probability of, let's say, 40% that your trading outcome will be successful. Now, you have done similar analysis with, let's say, a MACD. So you got a MACD here, moving average convergence divergence, and you know that it gives you about a 30% probability for the kind of trade you're looking for of having a successful outcome. Let's say you add on another indicator. It could be anything, RSI, moving averages in this case, and let's say that gives you a 20% probability of having a successful outcome. Well, so here goes the logic. At this point, you'll hear oftentimes, in fact, I heard one today, and it drives me crazy when I hear this, investing instructors say, well, wait for everything to agree, because it gives you a higher probability of having a successful outcome. Well, if you follow that logic all the way through, and you just use math, for example, and you add this to this to this, well, this says I have a 90% chance of having a successful outcome, right? So if I wait for all of these things to agree, this is a really good habit for me to get into because it's going to increase the probability of being successful. Well, the problem is that these numbers then don't match results, and the excuse that's given is just that it's too variable, it's tough to predict. But mathematically, there is an answer to why this does not turn out to be true if you just use more indicators. The problem becomes that I think that technical traders have to accept the fact that to a large extent we're kind of acting as we're using statistical analysis, which means that we're using some sort of a technical filter, whether it's price action alone or stochastics or whatever it is, to make a statistical estimate that our trading outcome is going to be positive. Now, if you were just doing traditional statistical analysis and you were trying to determine within a bag of marbles, I'm using a stochastics tool, and it's give me a 50% or 40% chance that the marble that I pick out is going to be red. And you were to use that, and then at that point, once you've pulled out all the red marbles that would have been predicted by stochastics, you use the MACD, and you're going to continue pulling out marbles that are indicated by the MACD and the moving average, and you continue pulling them out, and you're not putting them back in, you're pulling them out. You have a 90% chance that you will have found all of the red marbles within that bag. Here's the problem. That is a sampling method called without replacement. And you can do that in a sample set like this. And there are a lot of conditions in the real world that are like this, that you can do that kind of analysis, and it's without replacement. And so you can arrive at conclusions that that are cumulative, meaning that you can add these three together and you have a higher probability than using any one independently. The problem is the market is with replacement, which means that this variable does not, or this indicator does not affect the MACD. The MACD has no influence over the moving average. The moving average has no influence over stochastics. They're completely independent. They have no covariance, as you would say, which is a fancy way of saying that if you really want to know what your probability of a successful outcome is going to be out of a combination of these three indicators, it's this. It's just the highest probability. It's a really easy answer. Everything else is just kind of fluff. Now, you may say, well, okay, so what's the harm then? Is there, whether it's a fallacy or not, does this hurt me in any way to use more than one technical indicator? Well, actually it does. Here's the problem. Technical indicators of all kinds lag the market because we use past data. The technical indicator relies on the data that came before the present time to deliver whatever results it's delivering to you. So when you're looking at this, essentially what you've done by waiting for them all to agree and indicate a buy is that you have found a very efficient way to find the technical indicator out of this pool that lags the most. So whether that's the moving average, the MACD, or the stochastics in this particular trading opportunity, you've just maximized your lag in getting into the move in the market. Well, here's the problem with that. If this was your normal trading time frame, so this is the total top to bottom in this particular trend. Okay, so we'll assume this is top to bottom in the trend. This encapsulates the max trend, top to bottom. Now, we never get from the absolute bottom to the absolute top. I mean, obviously, you're always kind of lagging that turnaround here because you're getting in, after the market has already moved, and some kind of trading indicator has told you to get in. Some kind of analytical method that you're using has said, get in. Now, by maximizing your lag, what you've really done is you've cut this. You've always made sure that you have the maximum lag inserted. This constrains your trade time frame. It also constrains your profit potential. Now, this in and of itself wouldn't be as bad, except that traders typically are going to keep their maximum loss or their stop loss consistent. So just by waiting for the maximum lag isn't going to make them adjust their stop loss. So what they've done is they have really shifted that risk-reward equation without any offsetting benefit from having a higher probability of having a successful outcome. So mathematically speaking, this is a fallacy. And so if this can't give us a benefit, then the only thing we're really introducing is a disadvantage. We're shifting that risk-reward ratio, and we're introducing some very dangerous habits into our investing. Here's my advice to traders out there who like and use technical analysis. Keep it simple. So I never like to come out and just say, don't do this. One of the greatest things that I could suggest is simplify your investing. You'll find more opportunities. You're not going to really suffer on your probability of success. You're going to remove some lag out of your indicators. And if you want to know what indicators are available to me, what kinds of things could I try out, there's a lot of great technical analysis resources here that I've outlined in the article that you can use here on Learning Markets. Try them out. Find one that fits you. There's not particularly one that's inherently better than another. It's more what your preference is and how does it fit your own trading style. So experiment a little bit, but don't start to accumulate them.